If there is one moment that could completely shift the future direction of XRP, it is happening right now, and most people still don't realize how big this moment actually is. Many retail investors hear the words ETF, institutional inflows, or Blackrock involvement, and they think it only affects the traditional financial world. But the truth is that when institutional money starts positioning itself behind a digital asset, everything changes. The price behavior changes, the liquidity structure changes, and the long-term value of the asset becomes heavily influenced by demand that never stops. That is why today's discussion is so important. Welcome back to BullionIQ, where I break down the crypto market in simple, clear, and easy-to-understand language. Whether you are an experienced investor or someone who is just getting into crypto, my goal is to help you think like a professional and understand the big moves before the crowd catches on. Right now, there is a strong belief from analysts like Claver that a Blackrock spot XRP ETF is not far away. In fact, he believes it is right on the horizon. But what is even more surprising is that a lot of XRP holders still don't fully understand how ETF inflows actually affect the price of the underlying asset. Some people think the ETF works separately from XRP itself, and that price only moves when retail trades on normal exchanges. But that is a misunderstanding. In reality, ETF inflows eventually lead to real XRP being purchased from the spot market. And once that buying starts, it creates a steady flow of demand that pushes the market in one direction. That is why it is important to understand the mechanics behind this process. A major part of the current speculation comes from what happened in November 2023. A document appeared on the Delaware Corporation Commission website showing an iShares XRP trust, the same format that BlackRock used before launching their Bitcoin and Ethereum ETFs. The filing looked authentic. It matched BlackRock's official structure, layout, and legal format almost perfectly. But BlackRock insiders claimed they didn't file it. The SEC didn't have any registration on record. Bloomberg ETF analysts said the information did not come through any official channel. Delaware officials eventually suggested the filing might have been fraudulent and referred it to prosecutors. This created confusion throughout the crypto community. Some people believe the filing was fake, while others think it might have been a leaked internal step that was not supposed to be public yet. Claver seems to believe there is more happening behind the scenes. Whether that filing was real or not, one thing is clear. BlackRock does not ignore opportunities worth billions of dollars. If smaller firms like Canary Capital are launching XRP-related products, BlackRock will not sit back. They dominate every market they enter, and they do it by taking the lead or quickly catching up. This is why many people believe a real BlackRock XRP ETF is coming sooner rather than later. Now think about numbers for a moment. BlackRock's Bitcoin ETF, IBIT, has been bringing in more than $100 million a day during certain periods. These are inflows from institutions, funds, and large investors who want long-term exposure. If even a fraction of that money begins entering an XRP ETF, the impact on the spot market will be huge. The important part is that ETF inflows do not stay as cash. They must be converted into the asset itself. This means if investors buy ETF shares, authorized participants create new ETF shares and deliver them to the issuer. The issuer then uses that capital to purchase real XRP, usually within one trading day. This creates consistent buying pressure, and when buying pressure is stronger than the available supply, prices move upward. This is why understanding ETF mechanics is essential right now. XRP might be approaching a moment where daily, automatic, institutional demand becomes normal, and when that happens, the market changes forever. When we look deeper into how ETF inflows actually work, it becomes clear why analysts keep saying that the real impact happens a day later, not the moment the ETF starts trading. Many people saw Canary Capital's first day trading volume of more than $58 million and wondered why XRP's price did not immediately react. But this reaction delay does not mean the ETF has no effect. It simply means most people do not understand how ETF settlement works. In an ETF, shares are bought and sold on the secondary market by regular investors, but the asset backing the ETF is only purchased when new shares are created. And new shares are only created when there is more buying pressure than selling pressure. That difference is what we call net inflows. So if an ETF receives, for example, $50 million of net inflows in one day, the ETF issuer is required to take that money and purchase real XRP from the spot market, usually on what is called a T+1 basis, meaning the buying happens the next business day. This is why analysts keep saying that delays matter. If the ETF has strong inflows today, the issuer buys XRP tomorrow. If there's heavy inflow on Friday, the buying moves to Monday, because markets are not yet fully 24/7. This old system creates a small time gap between investor activity and the actual buying of XRP on exchanges. But the important point is that the buying eventually happens, and it can happen every single day once inflows become consistent. When the ETF begins receiving daily inflows, it sets up a rhythm of constant demand that puts pressure on the spot market. And when this demand rises faster than the available supply on exchanges, prices begin to move upward. This is why many experts say the real price impact will not be visible immediately, but will unfold over time as inflows accumulate. To understand how strong this effect can be, look at what happens inside the ETF process. When investors buy ETF shares and more shares are purchased than sold, authorized participants step in. These are large financial institutions responsible for creating and redeeming ETF shares. If the ETF needs more shares, the participants deliver either cash or a basket of the underlying asset to the ETF issuer. In the case of a crypto ETF, this usually means they deliver money and the issuer buys the actual crypto asset. The cash received is transferred to the ETF sponsor, and the sponsor goes directly to major exchanges or over-the-counter trading desks to purchase the required quantity of XRP. This is where the real effect on the market comes from. The ETF issuer cannot simply claim to have XRP. They must buy it, they must hold it, and they must keep it in proportion to the shares created. This buying activity adds consistent demand that did not previously exist. Retail traders buy when they feel fear or greed. Institutional inflows, however, are systematic and emotionless. They follow rules, not feelings. And rules create patterns. Imagine sustained daily net inflows of $50 million, $100 million, or even $200 million. All of that must be converted into real XRP. Even modest inflows can create notable market impact if the available supply on exchanges is low. Many experts believe that XRP's liquid supply on exchanges is much smaller than people think, and that large holders have moved coins off exchanges into deeper storage. If this is true, ETF-driven demand could run into a supply shortage faster than expected. This is where long-term investors begin to see the potential for real price movement. The combination of low supply, growing institutional demand, and global awareness that XRP might play a larger role in the future financial system sets the stage for a major shift. And once daily inflows start becoming a routine part of the market, XRP's price behavior will no longer depend only on retail traders. It will be shaped by institutional mechanisms that operate with billions of dollars and strict financial structures. When we talk about the long-term price impact of ETF inflows, the conversation naturally moves towards supply dynamics. Many people assume that XRP has an unlimited amount of liquidity available on exchanges, but that is simply not true. Most long-term holders do not keep their XRP on exchanges. Institutions that are collecting XRP for strategic reasons also use cold storage solutions. Exchanges keep only a fraction of total circulating supply available for trading. So when an ETF begins buying XRP every single day through spot markets, it increases demand on a supply pool that is already smaller than many believe. This is why analysts say that even moderate ETF inflows could eventually overwhelm exchange liquidity. Once demand outpaces supply, prices rise, and they can rise quickly if the imbalance becomes extreme. In traditional markets, ETFs have already shown how they can absorb large portions of an asset's daily trading volume. With XRP, which has a fixed supply and a structured release schedule, the effect could be even more powerful. This is where the discussion about future adoption becomes important. For years, XRP supporters have talked about the asset's potential in the global financial system, especially in cross-border payments, liquidity bridging, and settlement solutions. Many believe these use cases would eventually bring an explosion of demand, but the timing was uncertain. Now, with financial giants entering the ecosystem through ETFs, the idea of large-scale adoption no longer feels distant. It feels like a natural next step. When millions of new investors begin treating XRP as a standard investment option, just like Bitcoin or Ethereum, liquidity will tighten even further. And if banks, payment companies, or global institutions start using XRP in high-volume corridors, the available supply on exchanges will shrink dramatically. In such a scenario, even a small increase in demand can create a large impact. This is the same reason experts say the market could move from a few $1 trillion in total crypto value to tens of trillions. Think about it this way. If another 100 million people enter the crypto market and even a small percentage of them choose XRP, the supply crunch becomes more severe. Add institutional allocation on top of that, funds, pension systems, and corporate treasuries that want exposure, and suddenly the market transforms. Blackrock alone manages more than $9 trillion. Even a 1% allocation to XRP from global asset managers would create a massive supply shock. And that is before considering central bank digital currencies, tokenization of assets, or cross-border payment networks that may use XRP as a liquidity bridge. One key point people often misunderstand is the difference between market capitalization and actual money entering the market. Market cap is simply price multiplied by circulating supply. It does not represent the amount of cash needed to move the price. When supply is thin, even a small amount of buying can push the price upward dramatically. This is why Bitcoin sometimes moves billions of dollars in market cap, even if only a few hundred million flow into or out of the market. XRP's circulating supply situation is more complex because of escrows, institutional holdings, and long-term storage. So, as ETFs create consistent buying, the price impact may appear much stronger than the raw inflow numbers suggest. Another example of rising institutional awareness is the Canary Capital XRP ETF launch.
It recorded $58 million in volume on its first day, more than any of the 900 ETFs launched in the same year.
This is not a small achievement. It signals interest from early institutional players. Analysts predict that inflows to XRP ETFs could reach between $5 and $10 billion in upcoming months if demand continues to grow. These inflows alone could change the asset's trajectory. When the world's largest funds and analysts take notice, it often signals that retail investors are behind the curve. The XRP community had been expecting this for years, but now the wider financial world is beginning to understand the opportunity. The momentum does not stop here. XRP has additional catalysts, including new ecosystem developments like Axelar's MXRP token, DeFi expansion, and cross-chain integrations. All of these developments contribute to reducing the amount of XRP that remains available on open markets. And once ETF demand meets a tightening supply, price discovery becomes inevitable. Alongside ETFs, another major development is the expansion of XRP into DeFi through projects like MXRP on the BNB chain. For years, XRP has been limited in its native ability to generate yield because of its consensus design. Unlike Ethereum, it cannot natively support staking or other DeFi protocols. That meant many holders had to leave XRP idle, limiting participation in decentralized finance. MXRP changes that. It allows XRP holders to mint a tokenized version of their coins that can be used in DeFi applications like lending, liquidity pools, and yield farming. Suddenly, XRP becomes an active participant in decentralized finance. Investors who previously could only hold XRP for speculation now have a way to earn consistent returns, which reduces the amount of XRP circulating on exchanges and increases long-term holding. This is important because the lower the circulating supply, the higher the potential price impact when institutional inflows hit the market. The integration of MXRP also introduces cross-chain utility. By bridging XRP into other ecosystems like BNB Chain or other EVM-compatible platforms, holders gain access to a broader range of financial tools. They can participate in market-neutral strategies, earn interest on deposits, and provide liquidity in decentralized markets without selling their XRP. This effectively locks more coins away from the open market. As ETF demand begins, this locked supply becomes even more significant. It limits how much XRP is available to satisfy inflows, and scarcity drives price increases. In other words, every factor, ETF inflows, DeFi adoption, cross-chain usage, works together to tighten supply and increase the value of XRP. Institutional adoption also gains credibility through partnerships with established financial firms. Ripple's collaboration with companies like Franklin Templeton shows that traditional finance sees value in XRP. This legitimizes its use case beyond speculation. When investors know that banks and asset managers are using or planning to use XRP in operational systems, confidence grows. Institutional money flows are attracted to such legitimacy because it reduces regulatory and operational risks. In combination with ETF inflows, this can create a positive feedback loop. As more institutions participate, more retail investors gain confidence, increasing demand and pushing prices further. Another point to consider is how all these elements interact in the ecosystem. ETFs, DeFi tokens, treasury management solutions, and cross-chain utilities are all emerging simultaneously. Each development on its own can drive interest and adoption, but together they create exponential effects. Imagine ETFs injecting hundreds of millions of dollars a day, while MXRP locks up more XRP for DeFi participation. The visible circulating supply shrinks and market pressure builds. Simultaneously, institutional partnerships reinforce confidence in the system. The market is essentially being compressed from both sides, reduced available supply and increased demand. This is a rare alignment that can push assets to unexpected levels quickly. Additionally, new products like treasury management solutions for XRP, designed for institutional holders, further reduce circulating supply. Companies planning to hold XRP for strategic purposes often prefer long-term custody rather than selling or leaving it on exchanges. Combining this with DeFi locking and ETFs creates multiple layers of supply reduction. Analysts argue that this is the type of environment that has historically caused explosive price movements in other cryptocurrencies, and XRP is poised for a similar trajectory if these trends continue. Timing matters, though. Investors who understand the sequence of these events, the ETF inflows, settlement processes, and DeFi adoption, will likely have an advantage over those reacting late. Finally, the psychological effect of growing institutional interest cannot be underestimated. When the broader market sees major financial players engaging with XRP, it signals legitimacy, stability, and opportunity. Retail investors who might have hesitated begin entering the market, often at higher prices, further pushing the asset upward. The alignment of institutional inflows, reduced circulating supply, DeFi adoption, and global awareness creates the perfect storm for XRP price movement. If these factors continue building, XRP could experience sustained upward trends that surprise even experienced investors. As we continue exploring XRP's potential, it's important to focus on how ETFs, DeFi adoption, and institutional participation combine to create a powerful market dynamic. ETFs bring systematic, predictable buying pressure that is not based on emotion. Unlike retail traders who react to fear and greed, ETF inflows are structured and continuous. When a large ETF like Blackrock's enters the market, it creates a baseline of demand that happens every single trading day. This predictability allows analysts and institutions to plan around inflows, knowing that every day a certain volume of XRP will be purchased to back ETF shares. When net inflows consistently exceed selling pressure, the ETF begins to absorb a significant portion of the liquid supply available on exchanges. This reduces market liquidity and sets the stage for higher price appreciation over time. Meanwhile, XRP's DeFi layer continues to grow, with MXRP and other tokenized versions of XRP becoming available for lending, liquidity provisioning, and yield farming. The amount of XRP held idle on exchanges decreases. Long-term holders increasingly move coins into DeFi protocols to earn yield rather than leaving them on exchanges. This has two effects. It reduces the circulating supply and encourages long-term holding. Investors are less likely to sell when they have their coins actively earning returns, which further tightens supply. When this occurs simultaneously with ETF inflows, the spot market experiences a compounded effect. It is a situation where both demand increases and available supply decreases, a classic recipe for price growth. Institutional partnerships amplify this effect. Ripple's collaborations with major financial players like Franklin Templeton demonstrate real-world use cases for XRP beyond speculation. These partnerships validate the network's utility and attract more conservative investors who previously avoided crypto due to perceived risks. The combination of institutional trust, DeFi opportunities, and ETF inflows creates a feedback loop. More institutional involvement drives confidence among retail investors, which increases secondary market activity, attracting even more institutional attention. The cycle continues, and each layer strengthens the others. Supply mechanics remain a critical factor. XRP's total supply is fixed at 100 billion, with a significant portion held in escrow. Retail investors only control a fraction, while institutions and strategic partners hold large amounts in cold storage. When ETFs start purchasing XRP from the spot market, they are competing for a limited pool of available coins. The fewer coins available for purchase, the more dramatic the price impact. Even modest daily inflows can trigger notable price movement if the circulating supply is already constrained. Analysts highlight that this is one reason why XRP could respond more dramatically to ETF-driven demand than some other cryptocurrencies with higher liquid supply on exchanges. Another factor is cross-chain integration. MXRP allows XRP holders to participate in multiple ecosystems, such as BNB Chain and other EVM-compatible networks. This adds an additional layer of demand because coins used in DeFi are effectively removed from the immediate market. The combination of ETFs, DeFi locking, and treasury management solutions reduces liquid supply while simultaneously increasing the utility of XRP. Investors are incentivized to hold their coins, which lowers sell pressure and strengthens price support. When these mechanisms are synchronized, it creates a scenario where upward momentum can be sustained over time. Finally, psychological and social dynamics amplify the financial mechanics. News of institutional adoption, large ETF inflows, record trading volumes, and cross-chain DeFi participation attracts attention from retail investors who previously stayed on the sidelines. This increases trading volume, spreads awareness of XRP's potential, and encourages a broader adoption of both holding and investing strategies. The result is a coordinated, multi-layered environment where ETFs, DeFi, institutional validation, and retail interest work together to create a strong, lasting effect on the price and market capitalization of XRP. Now, as we bring all the pieces together, it becomes clear why the XRP ecosystem is at a critical moment. The combination of ETFs, DeFi adoption, institutional partnerships, and limited supply creates a perfect storm for potential price growth. Every piece of this puzzle reinforces the others. ETF inflows provide predictable, structured buying pressure. MXRP and other tokenized XRP options remove coins from circulation, increasing scarcity. Institutional involvement adds credibility and confidence. Retail investors observing these developments are likely to enter the market, creating additional demand. Together, these elements could drive significant price appreciation and change the way XRP is perceived globally. One of the key takeaways is how ETF inflows translate into actual market impact. When investors buy ETF shares, net inflows trigger the creation of new shares. Authorized participants then deliver either cash or a basket of assets to the ETF issuer. In XRP's case, the cash is used to purchase real XRP tokens from the spot market. This is not theoretical. It is a structural mechanism designed to keep ETFs fully backed. Each time this happens, the demand for XRP rises while the liquid supply on exchanges shrinks. Over time, consistent inflows create a snowball effect. The more money enters, the more XRP is bought, the fewer coins remain on exchanges, and the higher the price pressure grows. This process can happen daily, creating sustained momentum rather than a single one-off spike. DeFi adoption strengthens this effect by allowing long-term holders to earn yield while keeping XRP off exchanges. MXRP, Axelar, and other cross-chain integrations make it possible for XRP holders to participate in lending, liquidity provision, and other decentralized finance activities. As more coins are locked into these protocols, the available supply for trading decreases further. In effect, ETFs and DeFi solutions work together to tighten the market. Less available supply, paired with structured institutional inflows, creates a market where even modest retail activity can have a notable price effect. This is a scenario that many analysts have been predicting for years, and it is now materializing. Institutional partnerships further validate XRP's utility. Collaborations with companies like Franklin Templeton show that traditional finance recognizes the value and reliability of XRP as a bridge between fiat and digital assets. These partnerships also attract cautious investors who may have avoided crypto previously. With increased adoption by banks, asset managers, and other large financial institutions, XRP's network utility expands. More real-world use cases mean that price support becomes more stable, creating a foundation for sustainable growth rather than speculative spikes. Investors who understand this layered approach have a clear advantage in timing their entries and exits. Psychological factors also play a major role. News of record trading volumes, successful ETF launches, and expanding DeFi ecosystems creates awareness among retail investors. When these investors see institutional adoption and structural demand, confidence grows. Higher confidence translates into more buying, which in turn reinforces the ETF and DeFi-driven momentum. The network effect of increased attention, combined with reduced circulating supply and institutional credibility, creates an environment where XRP's market capitalization can grow substantially. Analysts have projected inflows reaching billions of dollars in the coming months, which could push XRP into levels previously considered ambitious or unrealistic. Finally, the future of XRP is not just about short-term price moves. The integration of ETFs, DeFi institutional adoption, and cross-chain interoperability positions XRP as a long-term bridge between traditional finance and decentralized systems. Investors who understand this dynamic are not only speculating on price, but participating in a system that could redefine how capital moves globally. In other words, XRP is evolving from a digital currency into a financial infrastructure asset, and early participants could benefit immensely. The combination of structural buying, reduced supply, yield-generating opportunities, and real-world partnerships suggests that the next phase of XRP's growth could be both significant and sustained. This is why monitoring ETF developments, DeFi expansion, and institutional partnerships is critical for anyone holding or considering XRP today.